Money did not emerge from ambition. Money emerged from necessity. Before coins existed, economies operated on barter. Barter failed at scale. Goods could not always be exchanged equally. Trade required a common measure of value. That measure became money. Around 3000 BCE in Mesopotamia, silver by weight became a unit of account. Temples and palaces stored commodities and precious metals. They recorded transactions on clay tablets. Deposits, withdrawals, and loans were documented. Interest rates were standardized. Financial records were preserved. This system expanded under Babylonian rule. The Code of Hammurabi established legal standards for lending, collateral, and repayment. Financial contracts were enforced by law. Credit became predictable. Predictability enabled commerce. In ancient Egypt, the state centralized wealth through taxation and grain storage. Grain receipts circulated as payment. Accountants tracked inflows and outflows. Economic control supported large-scale construction and administration. In Lydia, around the 7th century BCE, the first metal coins were minted. Coins standardized value. Trade accelerated. Governments controlled currency issuance. Monetary authority emerged. In ancient Greece, banking became private and competitive. Money changers facilitated trade between city-states. Deposits funded loans. Maritime trade expanded through financial backing. Wealth concentrated in commercial hubs. Greek temples also functioned as financial institutions. Sacred treasuries held deposits. Religious authority reinforced trust. Trust protected capital. Rome expanded finance through law and infrastructure. Roman bankers managed accounts, processed payments, and financed commerce. Contracts were enforceable across the empire. Roads and ports connected markets. Finance supported expansion. Roman taxation required efficient collection. Financial administration sustained the state. When political stability declined, financial confidence weakened. Coin debasement followed. Inflation rose, trade declined. After the fall of Rome, European finance fragmented. Coin circulation decreased. Economic activity localized. Wealth shifted toward land ownership. From the 8th century onward, Islamic civilizations advanced financial practice. Merchants used bills of exchange to avoid transporting gold. Partnerships distributed risk. Accounting methods improved. Trade networks spanned Africa, Asia, and Europe. Financial literacy spread with commerce. Capital accumulation increased. Markets expanded without centralized empires. By the late Middle Ages, European trade revived. Italian city-states dominated finance. Banks financed trade, governments, and warfare. Florence became a banking capital. Gold florins circulated internationally. Double-entry bookkeeping formalized accounting. Financial transparency improved. Businesses tracked profit and loss accurately. Capital allocation became deliberate. Banking families gained political influence. Loans financed monarchies. Debt bound states to bankers. Financial leverage translated into power. During the age of exploration, finance enabled expansion. Voyages required capital. Investors funded expeditions. Returns depended on trade routes and commodities. Risk was high. Profit potential was greater. Joint ventures emerged to manage uncertainty. Ownership was divided among investors. Losses were shared. Gains were multiplied. In the early 17th century, permanent joint stock companies formed. The Dutch East India Company raised capital from the public. Shares represented ownership. Investors traded shares freely. Liquidity was created. The Amsterdam Stock Exchange institutionalized securities trading. Market prices reflected information. Capital markets emerged. Governments adopted new financial tools. Public debt replaced forced taxation. Bonds financed wars and infrastructure. Creditworthiness became a national asset. The Bank of England was established to manage state debt. It issued notes backed by government obligations. Centralized banking stabilized public finance. Monetary authority expanded. cautiously. Trust replaced metal backing. Banking reserves managed circulation. Financial systems matured. In the 18th century, insurance markets quantified risk. Shipping, fire, and life insurance developed. Losses became calculable. Capital protection increased investment confidence. The Industrial Revolution transformed finance. Production shifted from manual labor to machinery. Factories required long-term capital. Banks mobilized savings into industrial loans. Railways reshaped economies. Massive infrastructure projects required unprecedented investment. Bond markets expanded. Financial intermediation grew. Commercial banks accepted deposits and extended credit. Investment banks structured securities. Capital flowed from savers to enterprises. National banking systems consolidated. Central banks regulated money supply. Gold standards linked currencies internationally. Exchange stability facilitated global trade. Financial centers gained dominance. London controlled global capital flows. Insurance, shipping finance, and currency exchange concentrated power. In the United States, early banking institutions stabilized trade. Political conflict over financial control persisted. Bank failures revealed systemic weaknesses. By the late 19th century, corporations replaced family enterprises. Ownership separated from management. Shareholders financed operations. Markets evaluated performance. Financial reporting standardized. Audits ensured credibility. Transparency supported investment. The early 20th century connected global finance. Capital moved across borders. Speculative markets expanded. Credit cycles intensified. The collapse of 1929 exposed systemic fragility. Excess leverage magnified losses. Banks failed. Depositors lost savings. Credit collapsed. Governments restructured financial systems. Central banks gained authority. Regulations limited risk concentration. Deposit protection restored confidence. Throughout history, finance evolved through crisis and reform. Each collapse reshaped structure. Each recovery expanded capability. Banks did not create wealth alone. They organized it. Investment did not invent progress. It accelerated it. Every major transformation followed capital alignment. Every expansion followed financial structure. Every collapse followed mismanaged risk. Money is not emotion. Money is mechanism. Finance rewards discipline. Finance amplifies organization. Finance powers scale. Empires rose with stable credit. Empires fell with broken trust. History records this pattern without exception. Those who understood money controlled movement. Those who controlled credit shaped outcomes. Those who mastered finance influenced civilization. This is not inspiration. This is historical record. Money did not shape the world by chance. It shaped the world through structure, law, and trust. This is how finance built power. This is how banks shaped history. This is how money moved the